All right. Well, good morning, everyone. Thank you for joining Raymond's webinar on building and navigating your personal financial plan. We appreciate you being here this morning. My name is Tom Wiggins. I'm a wealth advisor at Raymond Wealth and also lead our private client advisory practice. We have two great speakers with us today, Raymond leaders and Melissa Roush, advisory and tax, and Luke Terry from Raymond Wealth and a wealth principal as well. And a couple of quick notes before we start today's discussion. One, this will be recorded and you'll be able to view on Raymond YouTube as well as Raymond.com as well as past webinars. And then two, we do have a Q&A feature. So if you have some questions, please submit those and we'll address those at the end as we do have some time set aside for questions and answer. And we look at today's discussion. We're going to talk about the benefits of life planning, Roth IRA conversions, the pros and cons, and then personal planning, tax and wealth considerations. And then when we talk about life planning, that's really how our private client advisory team approach and working with our clients is all about. By surrounding our clients with a team of experts, we really help guide them through their life events and to provide clarity, confidence, and peace of mind. And we have a lot of life events, right? We have retirements, we have marriage, we have weddings, medical, death, legacy. They come at us at all different times. Sometimes it's hard to prepare, but we do want to plan. And by having this team approach at Raymond, we're able to be proactive, intentional, and really help us think of things our clients haven't thought of. And that's really the objective of today's discussion. Talk about some year-end planning, and then also about 2023 and beyond. So let's start first with life planning. You mentioned there's a number of events. We're going to kind of focus on estate planning and then retirement planning. From a estate planning perspective, right, there's probably a few events. We have marriage, you might have a family, you buy or sell a business, legacy, which would be at your passing, and then also medical. And the idea is that the more you can have a plan and prepare for these events, it just makes it easier and to have your wishes followed through as well. And there's really four main documents from an estate perspective to kind of help set that groundwork or that roadmap. One is going to be a will, and the will is going to allow you to identify who your personal representative will be to kind of help walk through that estate process. But it also will help if you have children that you can name a guardian as well for those children. And if you have specific belongings or things that you want to give to someone, and also will help in terms of if you have assets that are not in your trust, they can go through the will and into the trust. So that's kind of the first document that you want to have. Second is the trust document. Very important document. It's what they call a living, breathing document. You put all your assets in the trust while you're living, and that provides a number of advantages while you're living, and then also, at your passing. And one of the advantages is that it's creditor protection. So if your assets are in this trust, you do have creditor protection. Two, it also helps escape the probate process, where if you don't have your assets titled and going to someone, if it's not in your trust, or like life insurance, you have a beneficiary, or your retirement plan, you have a beneficiary, right? The asset is going to someone, or even a joint account, your joint checking account. If you do not have that, you just have a single account in your name, for example, a savings account. Let's say that it's just in your name. It has nowhere to go, right? So that's when the probate process takes over. You have to go to court, your personal representative, and then the court decides. Now, there's a hierarchy of where that asset would go in terms of family, but that's just an additional step, additional cost. But by having the trust, you escape that probate process. And when we talk about the trust in terms of kind of outline what your wishes are that you want to take effect. And that might be from, how your children receive their assets. We have, children that are really good with, money and those not so good. And I'm sure we all can relate with their own family situation. And, I have a client that has a 30-year-old daughter, 35-year-old son. And when we're looking through their estate plan, their daughter, very, very good with money, very responsible. Unfortunately, the son is not, can't hold down jobs, has a number of different girlfriends. So they want to really control and help protect him. So the way they set up the trust for distributions is that the daughter can receive the distribution lump sum all at once. So her share she will receive. Whereas the son, that will be spread out where at age 50, he'll receive 50%, and age 60, he would receive the remaining amount, and then receive income in between. So a way to help match your wishes and also help protect um, their son as well. You also, from a second marriage perspective, we see that where you both have split families, and you might go to the spouse, but then you don't want it to go to the spouse's children. You want your children taken care of. So you can set the document up that way. Also, if you own a business, right? How do you want those proceeds or that ownership split? If you have, a son who's very involved in the business, maybe the daughter not as much. The son gets the business, but then you can set up your estate plan where the daughter, the other children, then we get other assets as well. So the trust really provides you the opportunity to set up what your wishes are, how to protect others, how to protect your estate when going forward. And then third important document is the durable power of attorney. We call it financial power of attorney, which gives others access to help with your, expenses, pay bills and such if you're unable to. And this might come in since, right, a client whose father was in a nursing home and gave authorization to the daughter to pay bills and other financial matters. And it could even be in a short term. If there's some tragic event that takes place, you can have a springing power of attorney where someone can jump in and help with those financial issues. And then the fourth document would be the healthcare power of attorney. Very important. Out there, there's a little bit of a misconception that, if you're at the doctor, you're at the hospital, that you can just say, hey, go ahead and give the information to my spouse, significant other, family. That's really not the case, because the HIPAA and other really stringent rules and laws, you want this power of attorney that gives access for those doctors to talk to someone to give all the information that is needed in terms of medical care, maybe even end of life decisions. So really important to have that medical power of attorney. So you can see with these 4 documents, very important, nothing is set in stone. You can make adjustments to these at any time, as your life changes or your wealth changes, things of that nature. It's just important to have, because we can all relate, Luke and Melissa and I, is that, when these situations take place and there's not a plan, these documents are completed, it just causes a lot of stress, a lot of grief, a lot of arguments within families, and some family relationships have been damaged forever by not having these documents in place. It's really critical to have that as part of the planning process. And next, we'll talk about retirement as well, and having a plan. It's never too early to start planning for retirement, even though it might be years away for some of you. However, as you can see with our picture about that roadmap and having a plan and what direction to go to, and we plan for a lot of things. It's the December here in Michigan, end of the year, holidays. People are going up north, probably going skiing or something like that. And we plan that trip, right? We know we're going to leave at 8 in the morning. It's take us 3.5, 4 hours to get there. Some contingencies, right? Might be some snow, might be some ice. We might be stuck in the McDonald's drive-through for 25 minutes. We build that in to know that we're going to get to some certain point. And that's with retirement planning, a real critical event that all of us go through, but it impacts us in different ways. If you kind of look at the spectrum of all the different clients that we work with, we have clients that retire at age 50. You might think, wow, at 50, how did they do that? Well, they had a plan. They knew in their 20s they were going to retire at 50, but the retirement time might be a little bit different. Yes, they're retiring maybe from the corporate world per se, but they're going to volunteer their time, work for a nonprofit, maybe do some part-time work. They are going to be drawing from their assets, but in a different way because of what their career has changed. And that investment strategy might be much different than others in retirement, right? Because they have 35, 40 years. They might have more of an aggressive investment strategy at that point. Clients 53 years old, had a liquidity event. He sold his business owner, very successful. He's going to go ahead and he's going to retire at 53 with that liquidity event. The proceeds from that sale are more than enough to help him through this retirement stage, as well as provide for his family. So from an investment perspective, might be very conservative, might just invest in bonds. Again, retiring around the same age, totally different outcome. We have other clients at the other end of the spectrum, might be older, 75 years old, and their goal is really legacy. They want to provide for their children, grandchildren, and charity. So they have a 50-year time frame maybe investing very aggressively during that point. And even at 75, it's kind of the retirement, they've accumulated a lot of wealth. They might want that to continue to grow and still be aggressive with that and strategy as well. And then third, probably the most one we can all relate to is kind of that normal retirement age, right? 65, give or take you a few years up and down that scale. We're seeing a lot more earlier than 65. And you save for 30 years in your 401k plan. You're going to have Social Security. Your living expenses, might be 70% of what they were when you were working. And that balanced portfolio might be appropriate for you for the next 25 or 30 years. And you want to kind of prepare for that point with the investments, maybe not be as aggressive as you get close to that date. So you can see through these different life events and how they impact all of us differently. It might be the one event, but the outcome and how we manage that is going to be different as well. So there's a lot of things to take consideration for. And as you can see here by this slide, and our discussion all about today, this morning, is about planning. We don't want to predict, hard to predict, but we can always plan. And that's one thing that we can control in our lives and do the best that we can. And then I'm going to go ahead and pass it off here to Melissa to talk about Roth IRA conversions, the pros and cons. It's got a lot of discussion this year and past years as well.
Actually, I'm going to steal the mic.
Sorry, Luke. Yep.
Yeah, I know. That's okay, Tom. I'm going to steal the mic from Melissa. Melissa and I are going to actually discuss the Roth conversions. But first, I wanted to kind of walk through the refresher of Roth IRAs. So really, there's two ways to put money into IRAs. You have a traditional IRA where contributions are tax deductible going in and taxed as ordinary income coming out. And then you have your Roth IRA contributions, which are after tax going in, but tax-free distributions coming out. Now, most 401k and 403b workplace retirement plans, you're usually able to make pre-tax or Roth contributions from the form of salary deferrals, but employer contributions are always pre-tax. So there's two ways to get money into a normal Roth IRA. One is just a direct contribution via the front door. That's subject to income limitations, though. There's another strategy to potentially utilize called the backdoor Roth IRA. But both of those options, you're limited to only $6,500 a year for 2023 if you're under age 50, or $7,500 if you're over age 50. So what Melissa and I are going to chat about is actually converting money from pre-tax accounts to Roths. And there's really no limit on those conversions. You can do $5,000, you can convert $1 million. And as long as you can afford to pay the taxes with outside funds and you don't need the proceeds anytime soon, it may make sense to consider a conversion. So we're going to kind of walk through some of the pros and cons to a Roth IRA conversion. So the number one pro is really we're just moving depressed assets from a pre-tax IRA or a 401k to a Roth. And so a quick example would be, assume an investment in your IRA is declined by 50%. If you keep it in that IRA, then the recovery and all the future growth from that account is going to be treated as ordinary income. If instead you convert it to a Roth IRA when it's down 50%, then all that future recovery and future growth becomes tax-free.
Yeah, and it becomes tax-free in terms of income tax. It is still includable in your estate at the date of death value. I know that's a question that comes up on occasion. So, Luke and I have talked about something to think about, though, when you're considering a Roth conversion do you have plans to do large qualified charitable deductions in the future, or QCDs? And I think you need to be realistic with yourself on that. If you really think that you're going to do $100,000 a year once you're the appropriate age, maybe it doesn't make sense to do so much conversion now and pay tax on it, because you're going to avoid the tax down the road anyways. The other thing, I don't think you want to overlook a loss opportunity to convert. Do you have a casualty loss? Did you have a second home in Florida that got hit by the hurricanes and you've got a large loss in your return this year? Are you going to have a large charitable contribution for something? You have a bunch of stocks that were options that you got from work, and now you're going to contribute those because you've held them long term at this point, well, you're going to have a large charitable deduction. We can offset with the Roth conversion. And then the other thing for a lot of business owners, if it's a down year and you could end up in an NOL position, it may make sense to do a Roth conversion that year.
So another pro is, one of the benefits of a conversion is you actually can potentially lock in lower income tax rates than what you deducted during your contribution years. And so, for example, most of our contributions, pre-tax contributions, are potentially during your peak income years, possibly where you're able to deduct 35 to 37% upfront. So converting when you're in your lower income years, you could potentially lock in a 12 to 22% tax ramification there. And that really nets you a permanent tax reduction, so you can kind of play some of that tax arbitrage.
Right. The thing that you and I talked about before is we don't have a crystal ball into the future. We don't know what tax rates will look like. They could go up, they could go down. I mean, when you look back anytime recent, the lowest we've seen is a top rate of 35%. So, what I would say here is the bigger the spread in the rate that we're predicting, the less risk you have. So if we think that converting now will be at that 22 or 24%, and you'll be in a 37% or whatever top rate is in the future, that's where we can feel a little more comfortable that it makes sense to do it versus, if we're bordering, we don't want to convert at 32, 35% maybe, if that could be where you end up in the future anyways.
One last pro that we have here is really taking advantage of those lower tax brackets in your lower income years. For instance, if you're between jobs or after retirement, before Social Security or required minimum. And by the way, required minimum distributions, when you turn 72, the IRS forces you to take a set amount out of your pre-tax IRA. They force you to pay the tax. So if you have a time period between Social Security or required minimum where your tax brackets may be lower, you can kind of use those conversions to kind of bridge from the lower income years until you might be in a higher income bracket when you hit RMD.
Yeah. So I think that, again, I would want to say, be careful and honest with yourself when you're considering both your current and your future tax picture. How likely is it that one of the spouses will end up single? Do you have a large age difference between the spouses? Do you know that one has an illness so they may pass sooner than the other? So once we know that, if we think that we'll likely have a long time frame that one spouse is single, it kind of ups the ante for us to want to say maybe we convert, because that single individual will end up in higher tax brackets much sooner. Sometimes we're surprised though, and this is where your advisor needs to take a look with you, and we decide, can we even move that needle? We may be a little more aggressive and say, yeah, we're converting at 32% now, but we think once this individual is single, which is almost definitely a given, it will be at 37%. Maybe it makes sense. If we're having to convert at 37%, and we think that individual as a single person will be 37%, we're not going to move the needle. And so does it really make sense to do the conversion? I think a couple other things to think about are, what tax rate will your beneficiaries be at? So you and your spouse, once you pass away, who ultimately is inheriting that IRA? Is it your children? Are they doctors and they're already paying or will pay once they're out of school at high tax brackets? Or, did they go to school for something that's going to keep them in a lower tax bracket? If you think they're going to be in a lower tax bracket than you, then it likely makes some sense to say, I'm okay with them having some taxable income post my death, because I'm not really costing them too much with it. And then the other thing is, do you have plans to leave some of your estate to charity? If you do, it's going to pass tax-free to that charity anyways, so it may not make sense to pay the tax right now. to do the conversion. So just lots of things to look at and consider. It's very individualized. I think you need a projection with your advisor to really know where you stand with it.
Yeah, and then there's also, there's 3 tricky 5-year rules, and it's something you really can't sleep on those. So the first one is with your normal Roth IRAs. Those must be open 5 years before earnings would be tax and penalty free. So if you're over age 59 and a half, tax would apply on any earnings if you withdrew the funds before you had that account open for 5 years. If you're under 59 and a half, tax and penalties on those earnings for withdrawals within 5 years. And keep in mind, for your normal IRAs, any withdrawals of basis, which is your original contribution, those are penalty free, and you can take those out first. And that 5-year clock, it really starts with the first day of the tax year that you make the contribution. For instance, if you open an IRA right now, December 13th, and make a contribution, the IRS looks at that contribution as of 1/1/22 for that 5-year rule. So the second 5-year rule really applies to what we're talking about, the conversion. The tax and penalty actually applies to all the funds on conversions, the contributions, any growth, and each conversion starts its own 5-year clock. The reason the IRS did that is they don't want people to kind of game the system and convert pre-tax money to a Roth and then go ahead and pull Roth money out tax-free. So you got to keep track of that. And the last one's a little tricky too, because it's related to inherited IRAs. So the key there is that inherited IRA, it just has to be open for 5 years. So between the original owner and whoever inherited it. So if the original owner only had it open for 2 years, and the beneficiary inherits it and starts taking money out, tax and penalties could apply. So you got to keep track of that. And so as a summary, Roth conversions can be a really powerful planning tool to utilize, but as with anything, it has to make sense for your particular situation. So with that, we're now going to turn it over to Melissa to talk a little bit about some personal tax planning.
Sorry about that, I was muted. I think we're going to the inflation reduction slide here. So this is something that we did have a session on last week. And once, if you request the slides, there's a little link there up in the right-hand corner, and that will link you to more information on the Inflation Reduction Act. Kind of a high level here, though, some key things that we're seeing buzz around. Clean energy credits, and I'm going to say for the most part, all of these credits in the Inflation Reduction Act are really, a lot of them are extensions of existing credits and not necessarily new credits, though there are some nuances and additions here. So the clean energy credits, there are both business and residential implications of that. The business ones have a little bit shorter time frame where they're helpful versus the residential ones. And the residential is going to be on your HVAC, your windows, your doors, things like that. It's a pretty limited credit there. I want to say it's about $1,200. The electric vehicle credits is extended through 2032. They lifted some of the restrictions there in the terms, or in the sense that manufacturers used to have a limit of how many vehicles they could produce and their vehicle be eligible for the credit. They lifted that restriction, but they added other restrictions. Right now, the ending assembly of the vehicle has to be in the US. And then over time, there's phases in of when, what portion of the parts need to be produced in the US. So a little bit more restriction in exchange for some of lifting of old restrictions. The maximum credit, if you're purchasing a new electric vehicle, is $7,500. And then something new that they've added to this particular credit is a credit for purchasing a previously owned electric vehicle. And that one is limited to $4,000 for the credit. So definitely there's more details and nuances there, and something your advisor can help you with. And then the last one that's a little bit interesting is up to $1,000 credit for the installation of a home charging system. And it's really specific right now in the tax year 2023. So in just a few weeks, it opens up to more types of charging stations that you can install and get this credit on. So the next couple of things on here are just kind of how did they fund this? These are obviously tax cuts. We have to fund them on the other side. The plan is to fund it with this 15% corporate minimum tax and a 1% excise tax on corporate stock buybacks. And then an extension of the excess business loss limitation rules for a few years. So that's how they're planning to fund it. And, you know, a big part of this plan that we hear a lot about in the news is that about $80 billion of funding increase to the IRS, which as a tax professional, I find critical that they have the money for proper infrastructure. You know, I don't know that we've seen a plan of exactly how they're going to use that funding. I did just read something the other day, some senators saying we need a little bit of oversight here, not necessarily saying we shouldn't give them the funding, but we want to make sure that the funding is going to the right places. Can they do that? Will they do that? I don't know. But that is kind of the most recent buzz on this. Again, if you need more details, I would reference you back to the session that was specific to the Inflation Reduction Act. And I am going to pass it on to Luke to talk a little bit about retirement updates.
Yeah, a lot of changes. Thanks, Melissa. A lot of changes. And keep in mind, these slides are going to be made available. So I'm not going to address every single item on here. But in response to the inflation we've recently had, the IRS provided some tax inflation adjustments for 2023. And these are some of the largest on record. You know, the 401k, 403b workplace retirement plan has increased from $20,500 a year for a salary deferral up to $22,500, almost a 10% increase, even larger for over age 50. And just to put that in perspective, normally you see a change maybe of $500 a year on some of these retirement plan contributions. And so from a planning perspective, you know, I look at pre-tax retirement contributions. It's kind of a guaranteed return in the form of reduction of taxes, especially if you're in those highest tax brackets, a guaranteed reduction of income tax between 35 and 37%. So I'm a big advocate of taking those deductions in your peak earnings years. So the next slide, I'm going to kind of talk a little bit about the health savings account, the Roth IRA, and you know, health savings accounts. They're special savings accounts that you can have if you have a high deductible healthcare plan. Health savings accounts have kind of the trifecta as far as tax breaks out there. You're allowed to put pre-tax deductions in for contributions. Those contributions can grow tax deferred. You can actually invest those funds if you'd like to, just like a normal, you know, retirement account. And you can actually get tax-free withdrawals as long as you have a qualified medical expense. Now, the key there is the withdrawal if you have a qualified medical expense, and the distributions and the medical expenses don't necessarily have to line up. So you could have a medical expense in 2022 and have a distribution in 2025. As long as that medical expense has not been reimbursed and you have really good documentation, you can make that tax-free. So keep track of those records. The Roth and the traditional IRAs have jumped up about 500 a piece. And a planning idea we're seeing there is I'm actually seeing a lot of parents make Roth IRA contributions for their kids if the kids have earned income. Pretty powerful tool when you think about getting some of that money in those tax-free accounts for some of our kids' lifetime growth potential, all tax-free. The key there, obviously, is you got to have taxable income for those contributions to be made. And again, it doesn't have to be made by the kids. It can be made by parents. So the next slide, we're going to talk a little bit about some of the changes to the standard deduction. Pretty big change there, $13,850 for singles, $27,700 for joint. It's even higher if you're age 65. And one planning item to note, it's really important to know whether you are able to itemize in a specific tax year or if you're taking the standard deduction. Each year I have a number of clients that end up making some charitable donations, towards the end of the year or throughout the year. And they may not be able to itemize enough. So they end up taking the standard deduction, and you don't even get a taxable deduction on some of those donations. And so Melissa's going to talk a little bit later about some strategies on how to make some charitable contributions a little bit more tax efficiently. Another big change that everybody in our client base utilizes is the annual gift exclusion. And what that represents is gifts that you can make to anyone without reporting it on your tax return. So that amount is increased from $16,000 to $17,000. And if you're a couple, you can double that. So potentially $34,000 you can move out of your estate without reporting it. Another planning idea is we're actually seeing some clients gifting investments instead of just cash. And we'll chat about that in a minute as well. Then finally, the estate tax exclusion, we're at historical highs there for 2023. A single exclusion is almost 13 million. For a joint, it's almost 26 million. So keep in mind, those rates are subject to sunset, and I believe they're going to be cut in half pending further legislation. So moving on to the tax brackets. So I've listed all the tax brackets on here, and you can see that all of those have been expanded as well. And the way I look at those tax brackets, I think of them as kind of buckets of income. So once one bucket of a certain income tax bracket fills up, all your additional income kind of spills over into that next tax bracket. And so the only dollars that apply to that next tax bracket is when you hit above a certain threshold. So again, some of those planning ideas, as Melissa and I talked about those Roth IRA conversions earlier, kind of think about filling up those lower tax bracket buckets to kind of take advantage of those lower income tax years. I've got a number of clients that are kind of between retirement and required minimum distribution. And every year we're trying to fill up that 22 and 24% tax bracket. So we're making partial conversions each year. So the capital gains tax, there's 3 different rates there. And keep in mind, those rates apply to investment gains, which are held over 12 months. And so note that there actually is a 0% tax rate on income under $44,000 for a single, $89,000 for a joint. And one planning idea is, as I mentioned, sometimes we see gifts of securities to other individuals, kids or so forth. And there's a couple benefits there. Number one, maybe lower capital gains rates apply, or potentially even 0. And number two, it's an advantage or an opportunity to treat kids to how to learn some investments, how kind of the market works. Now keep in mind, work with your advisor on that, because kiddie tax could apply if they're dependents. Also note, there is the net investment income tax could apply in addition to those capital gains rates, depending on some income. And the rates that I mentioned, again, are for investments held longer than 12 months. If you have a taxable gain or loss on investment held for under 12 months, it actually applies as are treated as ordinary income. So you don't get those tax rates. And so that's going to bring us to kind of probably one of the biggest tax planning uses that we've had in 2022. There's not a lot of fun things to do when the markets are down, and in this year, there's not too many asset classes that aren't down, but it's called tax loss harvesting. Tax loss harvesting is recognizing losses in your investments, and it gives us the opportunity to reduce current or future capital gains taxes. So I'm going to walk through 2 scenarios. Scenario number 1 is, let's just assume you've invested $100,000 in fund ABC. It declines 25%, so it's only worth $75,000. But we're not going to do anything. So we're gonna stay the course and hold on to that fund until it recovers. So we're happy that it recovered, but we missed out on a potential planning opportunity. So moving over to scenario number 2, same situation, the fund declines by $25,000. And instead of hanging on to it, we're actually going to sell it. So we're going to harvest that $25,000 and move it over into what I call kind of a tax savings bucket. And you can do a couple things with that $75,000. You can leave it in cash for 31 days, or in this scenario, I'm going to reinvest it into fund EFG, which would be a similar investment, but the key is it's not substantially identical. So just like the first scenario, I'm going to assume that that investment recovers as well, back to your $100,000 as it did before in scenario number 1. And the key difference there is we now have $25,000 in this tax savings bucket. That $25,000 you can use to offset other capital gains that you may have recognized in other investments. If you don't have any capital gains, then you can use $3,000 of that tax savings bucket each year to reduce your ordinary income tax. And if you still have a tax loss harvest bucket or tax savings bucket at the end of the year, you can carry forward it to future years. And so this can be a pretty powerful tax savings tool. If you happen to be at the highest tax bracket, that could save potentially 25% or more in taxes. If it's a short-term loss, that could potentially be worth 45% when you add in state taxes as well. So there's a couple of things to think about. There is a wash sale that you have to be aware of, which essentially means that you cannot buy the same fund or investment 30 days before or 30 days after the sale, or else the loss is disallowed. So there's no penalty. It's just you don't get that loss, and you can't game the system and sell it from your taxable account and buy it in your IRA or buy it in a spouse account because that will be disallowed as well. And as I mentioned too, is those capital losses can offset other capital gains like real estate, investments, businesses, etc. And so maxing out those tax losses is really important, because the last thing I'm going to talk about is kind of a sneaky capital or sneaky tax that in the form of capital gain distributions. So next slide, Sam. The capital gains distributions, essentially what happens is mutual fund managers are buying stocks and bonds inside those funds. And if they have some losses in those funds and they can't offset those, if they have gains inside those funds and they can't offset those losses in a certain tax year, they have to pass that on to shareholders. And so you may get a tax surprise and you may not even know that it's coming. And so I've got a quick example here. This is a real life fund. It's an aggressive growth fund. And as you can see historically, a lot of years where we had double-digit returns, but year to date, this thing's down 35%. Well, if you hang on to this fund, if you're a shareholder as of the record date, December 20th, you're going to get a distribution of a 15% taxable gain distribution. Okay, so that's a pretty significant taxable gain surprise, and it's not publicized. So this is one of those things where it kind of surprises you at the end of the year. And so there's a couple strategies there that we can think about. To the extent possible, if we're going to hold on to some actively managed tax inefficient investments, put them in IRAs or Roth IRAs if possible. The second one, we want to harvest, go back to that tax loss savings bucket that I talked about. We want to take advantage of years like this year to build that up as much as possible, because we just never know about some of these tax surprises. And then there would be a scenario that it might make sense to sell this fund before that record date. Now, if you bought this fund back in 2012, you would have participated in a lot of gains, and it may not make financial sense to recognize a big gain to avoid a smaller gain. But what if you bought this fund in January? If you bought this in January, your fund's down 35%. It makes a lot of sense to harvest it so you avoid paying that 15% capital gain. And the last thing you got to be really careful on is making purchases in taxable accounts towards the end of the year. You know, if you're taking a look at this fund and perhaps you decide that, you know, December 13th is a great time to buy this investment because it's down 35% on the year. Well, you could be buying that fund right now, but in a week or two, you're going to get hit with a 15% capital gain distribution, and you didn't even participate on any of the gains. So you got to be really careful when you buy funds late in the year in a taxable account. So the best advice would be, you know, working with an experienced advisor to help minimize those scenarios. And with that, I wanted to pass it back to Melissa. She's going to talk a little bit about some charitable giving options.
Thanks, Luke. Those are some really important things to think about. So yeah, I just wanted to touch on 3 different types of charitable planning opportunities that sort of fall outside of your traditional, you know, I'm writing a check right to a charitable organization or dropping money in a kettle or whatever that may be. So the first one that we see that is, I would say, fairly common, probably underutilized, though, is a qualified charitable deduction. And what that is, it's when you make a distribution out of your IRA, your taxable IRA, right to a charitable organization. That check can't go to you for you to pass along. It literally has to go from the IRA custodian to the charitable organization. It does fulfill your annual RMD requirement. So it's a way to keep your income down if you know that you're going to be donating anyways. Currently, our RMDs start at age 72 under the Secure Act. You can start making QCD distributions at 70 and a half still. So if, you know, I have seen some, on occasion, you'll just see someone who has a really large amount of retirement assets, you know, 7, 8, 10 million. And by all means, it might make sense to start taking advantage of this as soon as you can, if you're in that situation. You can make a QCD contribution of up to $100,000 a year per person. So if you're married, you could do 200,000. It does need to come from each of your own IRA accounts. So spouse 1, it needs to come from their accounts, spouse 2 from their accounts. We can't take it all from spouse 1's account. So we have a little bit of separation there. And the thing with this is the income never makes it onto your tax return. You will still get a 1099-R. So it does, we report it for 1099 matching purposes, but then we kind of notate on the return that it was a QCD and it becomes non-taxable. The beautiful thing about that is that it keeps it out of your adjusted gross income, which means if you have other standard charitable contributions, it is giving you a lower AGI, so a lower limitation for taking benefit of those contributions. If you're in a state, particularly Michigan, where the base for state tax is federal AGI, you're going to get a benefit in the state too. You won't pay state tax on that QCD distribution. So there's definitely some benefits out there, you know, probably a little more minor, but if we can, you might be right on the cusp and it can trigger you into a lower AGI bracket and maybe a lower Medicare rate. Again, not huge, but it is something to think about. Some words of caution with a QCD distribution, though, are 1, they cannot be made to a DAF, so a donor advised fund, or a private foundation. So these have to go right to public operating charities, you know, a United Way, a hospital, a church, something like that, and then it's acceptable. You really have to, and your advisor could help step through an example, but as a real high level example of just the power of what you can do with this is, let's say you typically donate $50,000 a year to your church. And then you have $10,000 of state income tax deduction. So your total itemized deductions in that situation are $60,000. So we're reducing our income by $60,000. If you instead do that $50,000 contribution as a QCD, now you're in the situation of you're taking a standard deduction on your tax return. You and your spouse are both over the age of 65, obviously, because we're able to do a QCD distribution. And so your standard deduction in that case will be $29,400. So the net effect of doing the $50,000 as a QCD is a reduction to income of $79,400 versus the itemized deduction reduction of $60,000. So you're reducing income by an extra $19,000. There some other words of caution with these. They're easier to do in large chunks and not in small pieces. So I wouldn't recommend doing a bunch for $200 each. I would say save these for your larger contributions. It's easier all around. And you really need to keep close track of what QCD contributions you're making. So oftentimes I might get from an advisor as they happen through the year, if they're in contact with me on someone, they may just send me those notes through the year. And the reason is, if let's say something happens, and I've seen this happen where a spouse that did all the QCDs passed away, and we go to do the tax return and the living spouse doesn't know what QCDs were done, we can't take the benefit of that because if we can't track what was done, if we can't get a hold of the investment advisor for some reason, or weird things happen. So keep track, and like I said, larger pieces make the most sense on these.
Yeah,
So,
Melissa. Oh, I'm sorry. I
yeah,
just got just one point. When you're looking into the qualified charitable deduction, if you have low basis stock, we have a big gain. It might be worth just kind of comparing doing that or the QCD, because of that large gain. If you were to sell, it'd be 20% capital gain tax. You also
Yeah.
get a deduction. So kind of weighing the two to see what would be the best tax impact might be worth doing if you've got a lot of that low basis stock as well.
yeah, I think that's a fair point, Luke, I'm sorry, Tom, and that does come up. So the next type of charitable giving that's a little bit larger scale oftentimes than your standard contribution is a contribution to a donor advised fund. So this is a 501c3 that will have earmarked accounts for individuals who have donated money to them. Almost every investment custodian that I can think of, a Fidelity, a US or a UBS, any of them, they have donor advised funds usually that you can work through them. There are also trust companies out there that have these, and then there's independent organizations such as the Foundation of Southeastern Michigan. You can set up through them. So sometimes, as the person who funded the account, you're going to have some ability to direct, how the funds are dispersed. Do you want them all dispersed at once? Do you want them dispersed over a number of years? So it's a current charitable contribution when contributing to a donor advised fund, but there may be some legacy that you can attach to it. So it's an excellent tool if you would like to, for example, bunch charitable contributions, but take advantage of helping those charitable organizations over time. So, with the current high standard deductions, if you typically contribute, let's say $15,000 in a year, you may not really get any benefit of that because your standard deduction is higher if you're a married couple. But you could bunch 2 years of contributions into one and do $30,000 at once. So you would do this either in late December or early January. And then in 1 year, you'd get the standard deduction. And then in the other year, the itemized deduction. And we can usually get you into a more beneficial tax position from that perspective. They're also a really reasonable alternative if somebody just really has a desire to have a charitable fund in their name, but you don't really have enough funds to set up a private foundation, which is when you set up your own 501c3 charitable org. And that, a private foundation comes with annual filing requirements. There's annual distribution requirements that you have to keep track of, registration with the state attorney general, and pretty much all states that I'm aware of. It can be easy to overstep without meaning to do the wrong thing and end up in a prohibited transaction situation. And if you set up a private foundation, do you need someone post-death to manage that if it's still existing at that point in time? Kind of the general rule that I hear thrown out there is if you don't have at least, you're not thinking of giving at least 10 million, it may make more sense to put a lot of consideration into a donor advised fund versus the private foundation to avoid some of those rules and regulations that we have to keep up with.
Yeah,
So,
and I
and
think
Tom,
some
did you have
other,
thoughts?
yeah, I was just gonna say, just add, always talk about from a tax perspective. I mean, if you're charitably inclined, which you would be with this donor advised fund, a great strategy is definitely taking, if you have low basis stock or a concentration in one stock or fund, to move that over in the donor advised fund, because then you, one, reduce your taxes and don't have that potential capital gain. Two, it helps diversify your portfolio as well. If you kind of have this concentration, for example, I had a client bank executive, over the years, got a lot of stock, a lot of low basis, some significant capital gains, and it started to become a concentration in his portfolio, meaning it was, more of a larger piece. So we weren't diversifying enough. So we moved all that stock in this donor advised fund. And then within the donor advised fund, you sell that security, and then you can invest in different types of allocation funds. You want to be aggressive, conservative, or balanced. So it's really a great tool from there. And donor advised fund will exist beyond your lifespan. So you can actually name a beneficiary to help manage a donor advised fund for future contributions. And we've even seen for some real creative estate planning strategies, and Luke had touched on the exemption amount of 12.9 million of business owners actually putting some of their business in the donor advised fund as well. So when they sell, there's a number of different tax advantages. So it's a really good strategy. Again, most importantly, you're charitably inclined
Yep.
to use this and really maximize, as Melissa said.
Yeah, and that putting part of your business into the donor advised fund, that is one of those key things that can easily become a prohibited transaction if you're in a private foundation, and you can cause some pretty big issues there. So thank you for bringing that up. And so the next sort of not unusual, but out of the box kind of type of charitable giving that we see are charitable trusts. And I'm going to keep this real high level here just because it can get very complex. It's probably a whole session of its own, quite honestly. But we did want to mention this in case anyone has an interest in it. Check with your advisor and we can get you a little bit more detail. So there's two types of charitable trusts. There's the remainder trust and a lead trust. A remainder trust is sort of what it sounds like. The charity receives assets on the back end, the remainder of the assets. And then the lead trust is the opposite of that. The charity gets contributions to them from this trust over the term of the trust, and the beneficiaries receive the pot of assets at the end. The beneficiaries would be whoever you name, typically your children, your grandchildren, it could be nieces and nephews, whoever you want that to be. You can have a couple components when you set up these charitable trusts, but you most certainly have a charitable contribution at the point in time that you set up this charitable trust and fund it. I think that these are pretty neat myself. One of the things that I think that they can be good for is if you do a charitable remainder trust, you could set up, what's going to happen is that defined in the trust every year, XYZ will be the calculation to distribute to the beneficiary. That beneficiary could be you, it could be your spouse, it could be your children, your grandchildren. So, if I'm thinking I have a child who's, going to be 19 or a grandchild, and I want to get them a little bit of funding every year, I'm not so concerned with it being exactly XYZ amount. Maybe think about a charitable remainder trust. They're going to get a little bit of income flow every year. There will be income that comes out to them that's taxable to them, but a little bit of income flow or cash flow, I should say, for them every year. But it's limited to some extent. You're not just handing them a large gift every year to do whatever with. So if you're a little bit concerned, are they going to be responsible yet at that point in time? It can limit it a little bit, and you can certainly, if it's a low year, you could make up the difference if you needed to for them. The other thing to consider these with is in conjunction with a Roth conversion. So if I know I'm going to have a large Roth conversion, maybe I think about doing a charitable trust at the same time. Maybe I think about contributing into a donor advised fund at the same time. Those are really good ways to offset the tax blow of doing that conversion.
Yeah, Melissa, I think how we've seen these used for clients that definitely charitably inclined. Again, they have some highly appreciated securities that
Yep.
they can put into this charitable remainder trust. sell the securities, and just create a typical, balance or growth oriented portfolio to give to the charities at some point in the future. And they get this income stream. So it's a good way to diversify their portfolio. They know they're going to get this quarterly distribution. That amount, as Melissa said, restates each year. So it's just a good way for some income, some diversification, benefit charities from that standpoint.
Yeah, and what I've seen happen too, just because of the mechanics of how these trusts work, is if somebody does have a large amount of that low basis stock and they contribute it in, and then once it's sold within that trust, the trust isn't paying tax on that income usually because of the type of trust it is, and the income is being taxed to the beneficiary. There's a calculation sort of defined in the trust most times, of how do we define income? And so in many cases, what can happen is it spreads out that large gain over a period of years that the individual is paying the tax on it. So it can be a powerful planning tool from that perspective.
Yeah, great point, Melissa. Thank you.
Of course.
All right. Let's see. Any questions? I know that we had some questions come in during the discussion, and I think Melissa was answering them. I don't see any other questions in the chat. So as you can see, Melissa, Luke, and myself, really all of Raymond is very passionate about personal financial planning. Truly believe in the team approach to help with all these life events. And there's many more that we didn't cover, but the concept is the same. So as you know, with these events, there's challenges, but there's certainly opportunities. You have the right team to kind of maximize and, really help you with your goals and your passions as well. So I definitely want to thank Luke and Melissa for their time for this, and all of you for attending as well. We want to wish you a great holiday season and a happy new year.
And Tom, I just want to touch a little bit on one of the questions that did get cleared.
Sure.
If that's okay. And it was a gifting question because I think it's some important stuff that comes up often. For 2022, your annual exclusion is $16,000. It is per year per person. So, me to my daughter, if I make 10 gifts to them of $100, I've made $1,000 of gifts towards that $16,000 for the tax year. So it's not $16,000 per gift, it's in total for the year. You and your spouse can both gift to them, and then you would get $32,000 of annual exclusion gifts. There's a few ways to do that. If you have separate bank accounts and you write those checks out of separate bank accounts, you might be able to avoid having to do a gift tax return. If you write one check for $32,000 out of a joint bank account, we may have to file returns, albeit simple returns, but to gift split those gifts out between the two of you. And that annual exclusion amount goes up to $17,000 beginning of 1/1/23. So you have a little bit of a bump up there.
Great, thank you.
Yep.
All right, well, I guess one more. Yeah, I think one more question came in real quick. Do you see the question there? 34,000 per year per person you can give.
I see. Yes. So I think what this question is asking is, I have, a son and a daughter. Could we gift in 2023 $34,000 to the son, $34,000 to the daughter? And the answer to that is yes. Your annual exclusion is, per recipient, per gift recipient. So you do have the room there. And in fact, if your child was married, you could write a check for $34,000, say, to your son, and $34,000 to his wife, so you and your spouse effectively gifting to them $68,000 a year. And that applies across the board to a niece or nephew, a good friend, whatever the case may be.
Great, thank you, Melissa.
You're welcome.
All right, we have 1 minute. I already said thank you. I'll say thank you again if no other questions are coming through. We still wish you a great holiday season and a happy new year. Appreciate everyone's time today.
Thank you.